Let's begin, if we can, with the 19th.
Yes.
Rewind the tape.
Okay.
Where were you?
I was at
what
First
were you
Boston.
doing?
I was at First Boston, and I was an option trader. And I was trading a lot of things, mainly fixed income options and currencies. And currency options were extremely inexpensive at the time, during that period, for some weird reason, particularly for out-of-the-money options, for options that were remote. So I had accumulated a few of these. I also accumulated a very large amount of out-of-the-money options in treasuries and in short-term fixed income, for no other reason than they were much cheaper than I had seen in the past, and I was happy buying them there. So I had a large portfolio of these, and I was effectively short volatility. People don't fail to understand that I would have been harmed by a small move. You see, I was set up to be harmed by a small move and gain, if the move continues to something very large. And it was a very nice way to earn money if nothing happens, lose money if something mild happens, and of course make a lot of money if something huge happens. And that kind of position allows you to accumulate a lot of options in the tails. So that day, walking in there, I had absolutely no idea what was going on. I was hardly looking at stocks, focusing on fixed income. And then you had to remember, during that period, stock options were something very artisanal. It was a very small market. Not that many people traded equity options because there was no money there. There was no liquidity, no depth. Fixed income options, on the other hand, were huge. We came out of a big deficit, if you recall, a big inflation in the 70s. And in the 80s, you had so many bonds outstanding that was what you did when you wanted to trade. If you went into equities, it was, because you probably couldn't get on they wouldn't let you in on a fixed income floor. So that was, and we could trade in my department equity options, but there was no big volume for us. So it was an artisanal thing. And later on, when I became a pit trader, I was taking a sabbatical. It wasn't, it was to become an artisan and have a nice little life, working my own hours, sort of like the Uber driver of that business, you see, like a freelance trader. And you realize they're all freelance traders. So in that space, fixed income, equity options. So this is why there was no big, we didn't hear big stories then. Fixed income was very large. Another thing we got to remember is that portfolios were very large at the time, and options were driven mostly by big covered rights, like some people selling calls. Nobody was interested in puts. So when options, so the collapse happens, and there was no big liquidity. So the action was in currencies and fixed income.
Now, at what point during the day did you come to realize what was actually happening?
At no point. When you're trading, it's like in a battle, you see? Sort of like when I'm on TV. When I'm on TV, I don't know during the episode what's going on. It's later on that I realize, what I said. You see, you're concentrating. So like you're solving a math problem. You don't know your surrounding. But I remember it was a state of heightened concentration. I was 30 years younger. It was 30 years ago. So you can imagine you're in a state of concentration all day and didn't eat, knew something was going on, but didn't think about it. Didn't think about it in these terms.
But you saw prices going down.
I saw prices going down, and they kept going, and people were panicking. Hey, it keeps going. And someone came to me and made a remark. He said, don't they know that Six Sigmas are something you don't observe more than once per lifetime? I said, no, the market doesn't know it. I remember that was a joke. The guy was visibly suffering and in his own portfolio. But I was concentrating. It's very strange, these things, when you concentrate for 8 hours. And in my career, I've had 6 or 7 of these, like when Saddam invaded Kuwait. So I had to go to the office at like 2 a.m. and I remember it was a state of concentration for about 15, 16 hours. and didn't really think about the event in these terms till I took stock later. So it's the same thing with the stock market crash.
So when that moment came,
Yes.
when you took stock of what had happened,
Yes.
what went through your head?
I thought there's something in my guts that told me that what I was doing was right. Because I had weird theories that people really didn't believe in at the time. People still don't believe in them, but now I don't care, but at the time I cared. I was employed at First Boston, and so my business was buying tail options, out of the money options, and waiting for a large event to happen, and try to survive in between. Okay, so that was my business at the time already. Okay, I'm talking 30 years ago. So here's this guy in his 20s, was maybe brash, maybe confident, maybe, less confident than I am now, or whatever. This guy, it's hard to be taken seriously, you see, other than, hey, he's some kid who with a big ego. But after the event, I knew that I was right, and I knew that people would take me seriously.
You knew that you'd also made a lot of money.
I made a lot of money, and I also knew that all this financial modeling, everything you learn in class, all this Black-Scholes option model is nonsense. You see, I knew that because basically all they did is they focused on probabilities of a plane crashing, and here you see 100 planes crashing at the same time, right? Or 1,000 planes crashing. So you realize there's something wrong in their model. So I felt vindicated because I knew it was nonsense, and it turned out to be nonsense.
So that was your proof, effectively.
It felt, but it's sort of like it was good because it convinced me. So you feel this serenity and fear at the same time. I wanted, the firm to survive. I didn't want New York to be in trouble. I had an apartment in New York. I had my money. I had things. So I wasn't really bulletproof. Greenspan saved the system when he went and gave the money.
When he promised liquidity?
He gave liquidity. He made sure that margins were covered. Made sure that the system, the payment system, that's probably the only thing he did right in his life, all right? His entire life, Greenspan.
What would have happened had the Fed not stepped in on the 20th,
It would have been collapsed.
offering unlimited liquidity?
It would have been, first of all, it would have a lot cleaner financial system today, but it would have been a complete bloodbath then. So let's think now it was counterfactual.
Because there is a legacy to that statement,
exactly.
to that affirmation of the Fed's
So,
responsibility.
Exactly. So what happened then is that you have to remember one thing. Moral hazard had started in 1982 under, of all people, Ronald Reagan. Ronald Reagan nationalized Continental Illinois. So we had a nationalized bank. Continental Illinois had an option firm, bought an option clearing firm called First Option of Chicago. And they were so incompetent that they netted exposure by traders, not realizing that if the trader goes bust, the trader making money isn't going to write him a check. They're a clearinghouse. They're not a trading house, okay? It's not a family, okay? So all these, and then of course, First Option of Chicago went under, you see. Continental Illinois indirectly bailed out, and you know what happened to it. It eventually merged with something else. Then we saw already that you could make a huge mistake if you're an institution and be saved, if it's costly enough to the system. Individual traders went bust, they went bust. That's it.
Still do.
They're gone, all right? And critically, Greenspan thought that he had a magic wand, all right? You move it, you solve problems, and he started his interest rate lowering scheme at a time as a knee-jerk reaction. So, this, of course, he lowered interest rates 4 or 5 years later. Not even 4 or 5 years later. 3 years later, we had the RTC problem, if you remember. Mm-hmm. He lowered interest rates then dramatically.
The savings and loan crisis.
Savings and loan crisis. He bailed out these banks, if you remember, and he helped perpetuate moral hazard that eventually led to that crisis of 9 years ago, and we can't get out of it.
What did it feel like to you to come to this realization, particularly at the end of October the 19th, knowing that you were one of the few people who had figured out that there was this abnormal distribution to financial market events?
I didn't think in these terms. I started calling friends to see if they're okay, and effectively, my cousin, I mean, at times there was no cell phones, so you go home and then you have black cord fever, you start calling anybody you know to just chat about the event, and it can't leave the apartment because Hong Kong may call, you know, and something may happen. So, and I remember, as I was talking to my cousin, he said, well, there's a police downstairs. It turned out some guy, a fellow committed suicide on 72nd and 1st. So it tells you it was very close to home. But it's only after the event that I saw the panic. Sort of like one thing you learn from accounts of Roman legions, that when they got into battles, they have no idea what they're doing. It's automatic behavior. They're trained, maximum concentration. They don't think of anything until the battle is over. Then they realize, hey, you know what, I'm injured.
So going into that day, do you recall what the size of your positions was in nominal terms?
It was, okay, so to go back to the notion of nominal, it makes no sense to talk nominal because I was accumulating a lot of tiny options.
I see.
Tiny options. And I remember the P&L. In today's terms, it would be for the firm, I mean, something substantial in today's terms, but at the time, you know, it was not the same.
What was it in dollars?
Compensation was not the same. It was in the tens of millions, mid-tens of millions. And in today's terms, maybe 60, 70, 80 million in one day. For a trader just set up at a time, it was big.
A lot of money.
And for a guy like me,
how did First Boston treat you?
They treated me very well. Because, well, I mean, very, very well. The problem is it was still a communist system where everybody had to share. And everybody had lost money except for me and another fellow. So it was of course, we had some, but at the same time, they treated me relatively well. You got to remember that compensation at the time was nothing like today.
Do you remember how much you got paid that year?
I can't talk about it. I'm not going to talk about it because you call up someone and say what payoff traders had. But then, but I didn't cash it immediately. It took me 2 years of bonuses to get the whole payoff.
Ah.
You see? But
so,
yes.
And do you recall how you traded in those intense moments of concentration? How were you trading through the day,
yes,
the 19th and the 20th?
I remember the 20th. I get on a phone and I had set up, you know, so on. I had a trading assistant also, and got 15 phones and 200 screens. It was not like today. And you're shouting on phones. You had direct line to the pit, and direct line to Chicago pit, one Philadelphia, and one to the currencies, one fixed income, and then one, and then talking to the Board of Trade. And I remember there was a fellow called Richard Dennis. I don't know if you've heard of him. He's one of the famous people. He was famous at the time. He was bankrupt. He went bankrupt that morning, right, on the open. There was a trend in Eurodollars, a rally in Eurodollars. Okay, sorry, a trend of rally in interest rates. Okay, and the guy was short Eurodollars, and then the thing went to his face, and he lost his fund, which at the time was substantial, like $50 million fund, something like that. So they were liquidating the thing. And I remember I had a huge delta in Eurodollars, all right? I remember then vividly offering something, right, on a phone and selling it considerably higher. So the guy in the pit, you know, called Tim, I'd tell Tim sell here, and he would sell much higher. Okay. So it was like in Trading Places. Have you seen that movie? I got one, I got one. It was like that, all right? So all morning, so we spent the whole day, all right, liquidating, but all morning, I remember, we were selling above our offers. Just one here, one here, one here. I mean, you want to take time to unload your inventory. And sure enough, there was liquidation, and we got lifted on all our offers, and then of course came back. Interest rate came back to 300, up 300 on a day or something. So that was the first thing. Currencies went wild. All right, the dollar, of course, collapsed. dollar yen options. We had options we had bought for $10,000 in inventory. They were selling for 17 million, something crazy like in yen, all right? And the thing was going, all right? It was like, it was out of control. So the big payoffs were not in the main big currencies, but in the ones where the move was a big surprise, like euro dollars or yen. Swiss franc had high volatility relative to others. It wasn't as bad for participants in that. Yes.
Why is that such? Why do you think that's such an untold part of the Black Monday story? The action in Eurodollar futures and the action in currencies.
Because it's a professional market, and the professionals don't. I mean, the largest market was fixed income at the time. The largest market and currencies, include currencies, but people, only professionals talk about these things, and these professionals involved at the time are dead. But Black Monday, everybody remembers what happened to IBM because they owned IBM, but it's not the same scale. See, yes. And plus, there's another thing you got to talk about. When you talk about the stock market, it has a large inventory, you see, but the turnover is nowhere near what we had in fixed income.
Black Monday has been described as your epiphany.
Yeah.
How would you describe it?
No, I mean, I don't want to talk about myself because I mean, there's an effect of false memory when you go back. But I remember some scenes that were quite vivid. But I remember that I did not expect the next day, which me would be Gold Tuesday, rather than Black
That's where
Monday.
you made more money.
Yeah, of course. That was the big day for me is Tuesday, because that's when the action of Greenspan were vastly more momentous than when that happened in the stock market. You also have to remember that the stock market had high volatility relative to other things, and not that many people played in complex instruments because of that volatility. But yen, for example, didn't have a high volatility, so it fooled a lot of people.
If I'm not mistaken, talking about the equity market, the VIX reached a peak on Black Monday that it has never seen since.
Okay, there was no VIX at the time.
Right.
Okay, and even the VIX I consider it an artificial contraption, but it's general to see. So what I learned from Black Monday was that, number one, these things happen, and when they happen, everything you make elsewhere disappears. It took me another 30 years to figure out something I told you, 29 years was here to explain that unless you're hedged for a portfolio, unless you're hedged for events like Black Monday, whatever alpha, you know, you think you're going to get, you're not going to get it. Because what I call the ergodic problem, because what happens is that if you go bust on that day, there's no alpha. And most people don't realize that if you have to shrink your portfolio and things like that. Now, since the Black Monday, I mean, I didn't really think about it too much, except that here I had some cash. Okay, I realized it hit me after a while that I could do something else in my life than trade, you see. I was in my 20s, it was time, you know, I could figure out what to do. The problem is, I like trading a little too much, you see. So, particularly for these days where you feel deep in your guts that there's something you're doing right. It's not the money so much, although the money is like entertainment, form of it makes it easier. It was not, it was just, I like that.
So you learned some important lessons on Black Monday. What did everybody else not learn?
That these events are not outliers. They're a regular part of the system. See, so and there's a first mistake people made with Black Monday. Before Black Monday, those who wanted to do risk management went to the past and looked for the worst deviation, and it was something like 10%. So you had Black Monday, now, which was 2.2 times whatever the deviation. Now what do they do when they backtest? To Black Monday. I mean, don't you recurse? So there was a new field new field like 30, 40 years old field in science called extreme value theory. And it started with the Dutch who wanted to build to protect themselves. So how high should our protection be, right? So do you protect to the worst past? Of course not. It's logical that it can get worse, right? So you take the worst past and you multiply it by 1.5 or some factor, and you live with it. Yes.
If that's the case, why is it that people still continue to use models like Black-Scholes?
Because they don't pay for their losses. Someone else pays for the losses. And plus, if you're only going to be wrong one day, you see, and don't pay for your losses, so it's fine.
In other words, so long as losses are socialized, so long as there's moral hazard, people will continue to use these flawed risk management tools.
The losses don't have to be socialized. They could be just transferred to the taxpayer, to the shareholder. Like you work for a bank, okay, like the whale. The whale got what bonuses? $30 million bonuses the years before, and then he lost $6 billion. He didn't have to pay a penny of the $6 billion. So I call it the Bob Rubin trade, and you make $100 million over 10 years, and when a black swan event happens, you say it was uncertain, nobody could have seen it, and that's it. So it's very easy to use a regular model that predicts a regular. But sort of like it's very easy to sell people a seat belt that only works if there's no accident. Okay, so it's going to be comfortable, and if there's an accident, they're going to die. So they're not going to complain, all right? So that's sort of the idea.